Welcome back to the Dividend Guy. Today I wanted to make my second portfolio update relating to my quest to build a stable dividend machine. My first portfolio update had my holdings at $116,000, and as of today, my portfolio is worth $118,000, with me investing $1,000 in the last 30 days. I am going to break down the biggest changes, and then we will go over new positions. The biggest changes I made to my portfolio was divesting most of the international ETFs, as they had drastically underperformed over the last 2 years. I believe a large portion of the future growth is going to be in the domestic market, as Europe has an upcoming population crisis that will make it very hard for them to continue to have a skilled worker base to draw from. I repositioned these funds partially into GP, GPQ, and QILD, alongside boosting my position in ONSCHD. I understand that some people view international stocks as a potential boost if domestic markets go awry, but that is a risk I am willing to take. Other than that, my biggest holding of SCHD traded mostly sideways over the last 30 days, currently down about 0.31%. This is fine because I am still getting around $600 in dividends this month on the 31st. Over the month of November, I received $136 in total dividends, with most of my holdings not paying dividends this month. I received $72 from the 4th to the 10th of the month from my government bonds, GPI, GPQ, and corporate bond ETF. I received another $35 from the 11th to the 17th from Apple, EPD, and O. I received my last dividend on the 25th of the month, and it was from QYLD at a total of $27. This upcoming month will be one of my biggest dividend returns of the year, with $700 in dividends expected to pay out. Paying out will be Kroger, Nvidia, Chevron, Exxon, Microsoft, the SPDR Real Estate ETF, T. Rowe Price, Vanguard's Energy ETF, Vanguard's Utilities ETF, and my dividend ETFs of VIG, SCHD, DGRO, and VIGI will pay out as well. The biggest of these dividends will be on the 31st, when SCHD will pay me about $470. I have everything set to drip back into itself and have no plans to change that for the foreseeable future. As I mentioned at the start of the video, I did invest $1,000 into my portfolio this month. For that, I opened a new position in AMT, or American Tower Corp. American Tower Corporation stands out as a prime candidate for a strong dividend portfolio due to its combination of reliable income, consistent growth, and alignment with long-term market trends. As a global leader in communications infrastructure, AMT benefits from stable and recurring revenue generated through long-term leasing agreements with major telecommunications providers. Its focus on co-location maximizes profitability while maintaining cost efficiency, making it a scalable and sustainable business model. AMT's commitment to shareholder returns is evident in its 12 consecutive years of dividend growth and an attractive dividend yield of approximately 3.1%. Operating as a REIT, AMT is required to distribute at least 90% of its taxable income, ensuring consistent payouts to investors. Its track record of increasing dividends underscores its financial health and management's focus on delivering value. Moreover, AMT is strategically positioned to capitalize on the growing demand for wireless infrastructure driven by 5G adoption and increased data consumption. This alignment with technological advancements makes it a forward-looking investment with significant growth potential. While challenges such as high debt levels and regulatory risks exist, the company's robust cash flows and global diversification mitigate these concerns. I had been wanting to open a position in this company for some time, and I am glad it is now a core position of mine as I continue to diversify my portfolio. As for future changes I am still uncertain of, I do have a $1,000 position in Disney that has performed terribly. While I do think the company will have a turnaround due to its strong cultural moat, the stock is in a tricky position and their dividend became much less attractive. It is down quite considerably from my initial investment, and while it would be a loss, I am wondering if there is a better option to deploy this capital in. Considering the evolving macroeconomic landscape, I'm contemplating several strategic investments that align with potential opportunities emerging from industrial growth, leadership changes, and technological advancements. These include opening positions in an industrials ETF, exploring Intel as a turnaround play, and capitalizing on the broader semiconductor industry's prospects as domestic manufacturing gains momentum. The industrial sector often experiences significant growth during periods of increased infrastructure investment and economic policy shifts. With the Trump administration's prior emphasis on rebuilding America's infrastructure and fostering domestic manufacturing, there's potential for industrial companies to benefit from similar initiatives in the future, should such policies reemerge or influence the broader market sentiment. An industrials ETF provides a diversified way to gain exposure to the sector, spreading risk across a basket of companies involved in construction, machinery, transportation, and other critical areas. This approach mitigates the risks associated with investing in individual stocks while allowing me to capitalize on the sector-wide growth that could follow increased government spending or private investment in infrastructure and industrial expansion. Intel stands out as a potential individual investment due to its pivotal role in the semiconductor industry and the opportunity presented by its recent leadership changes. Historically, Intel has been an industry leader, but in recent years, it has faced challenges, including delays in product development and increased competition from rivals like AMD and NVIDIA. A new CEO with a fresh vision and a commitment to addressing these issues could reignite Intel's innovation and operational efficiency, positioning the company for a robust recovery. Leadership changes often bring a renewed focus on strategic priorities, operational efficiency, and market positioning. If Intel successfully executes a turnaround strategy under new leadership, it could regain market share, improve profitability, and deliver substantial shareholder value. Investing in Intel now could provide exposure to its potential resurgence, while the stock may still be undervalued relative to its long-term prospects. The semiconductor sector as a whole stands to benefit significantly from efforts to bolster domestic manufacturing capabilities. Chips are essential to nearly every facet of modern technology, from consumer electronics to advanced industrial equipment. Recent geopolitical tensions and supply chain vulnerabilities have underscored the importance of securing domestic semiconductor production. If the U.S. government and private sector increase investments in chip manufacturing facilities through incentives, subsidies, or direct capital outlays, companies across the semiconductor ecosystem could experience substantial growth. This includes not only chip makers like NVIDIA and AMD, but also companies involved in manufacturing equipment such as Applied Materials and Lam Research. By building up domestic capabilities, the U.S. semiconductor industry could reduce reliance on foreign supply chains, enhance innovation, and create jobs, all of which contribute to a favorable environment for investors. The push for self-reliance in semiconductors aligns with broader economic and security priorities, making this an opportune time to consider investments in this space. Dividend investing has become a cornerstone of my financial strategy, and my $118,000 portfolio generating $4,200 annually in dividends is a testament to its power. When I break it down, the numbers are incredibly motivating. My current dividend yield is 3.56%, which means that for every dollar invested, I'm earning just over 3.5 cents each year. However, what excites me the most is my yield on cost, which currently stands at 3.96%. This reflects how my initial investments have grown more valuable over time while continuing to deliver increasing returns. To me, yield on cost is one of the most rewarding aspects of dividend investing. Knowing that my original investment now earns almost 4 cents on every dollar annually reinforces the idea that I'm building a system where my money works harder with each passing year. As the companies I've invested in raise their dividend payouts, and as I continue to reinvest those dividends, I'm setting myself up for a future where my portfolio's income grows exponentially. The real magic of this strategy is in the compounding. Every year I take the $4,200 my portfolio generates in dividends and reinvest it into more shares of dividend-paying companies. This adds to my portfolio's foundation, increasing the amount of income I'll earn the next year. Over time, this reinvestment process creates a snowball effect. With the added boost of dividend growth from the companies I hold, many of which increase their payouts annually, my annual income steadily rises without any additional input from me. That is my monthly update. Thank you so much for watching, and hopefully I will see you all next month.